Good evening. Michael, can you hear me? Hello, Michael, can you hear me? Michael, kindly unmute and respond. Can you hear me? Hello, hello, good evening. Can you hear me? Unmute your mic and respond if you can hear me. Good evening, everyone. So, it seems majority of us are not online, but I hope they will join us soon. Um, Once again, you're welcome to Movie Peeps. It's a great honor for me to have you people join me on this part. So I welcome you again. And I said that I just want to say something about your decision to commit yourself to learning about the things that will be discussed in this platform. Um, so without wasting much time, we're going to start right away. So um, please, I want you people to respond if you're hearing me. Madam Faith, hello, can you hear me? All right. Um, Without wasting much time, we're going to start with the class, and I'll be sharing a slide. You can take notes, and also this class will be recorded live. It can be sent to the group later. So let me share screen so that you will see my screen. So I I welcome you once again to this class. First of all, I want you to know that Forex is not a get rich quick scheme where you come and maybe you're expecting to make money in a short period of time, and you tend to have that mentality. So I just want to clear that so that you get to know about that. So from the introductory parts, we are going to be taking the foundation of Forex today. It's a whole lot of bulk introduction, but I believe God will help us, and let's see how we are going to cover today. So, what we'll be treating today will be considering what Forex is, the market participants, fees and quote currency, Forex broker, market hours, and other forex terms like spread, pips and points, lot size, leverage, equity, and um, we'll be have also talking about stick profits, stop loss, other types, and market execution types. So that's what we'll be considering today. So briefly, I want to tell you what forex is all about. Forex is usually abbreviated as foreign exchange. Forex is usually abbreviated as FX, derived from foreign exchange. The short form of Forex is FX, and the full form of it is foreign exchange. And it simply means the simultaneous buying and selling of currencies. Um, just like you have every other market where they have products and services that are offered. In foreign exchange market, what we tend to buy and sell is currencies. Example, just like your Nigerian naira now is a currency, United States dollar, euro, Great Britain pounds, Australian dollar, Canadian dollar, New Zealand dollar, and Japanese yens. All these currencies are the things that are traded in the foreign exchange markets. Currencies are instruments with which transactions are conducted, and every nation in the world has its own currency peculiar to it. As you can see, the first two letters of each currency pair starts with the abbreviation of that particular country. Like the United States dollar now, we have USD, and the first two letters stands for the country's name, which is if you want to consider Nigerian naira now, we have NGN, which is Nigeria naira. Currencies like JPY is Japanese yen. Currencies like CAD is Canadian dollar, AUD, Australian dollar, and so forth. So there are bodies that um, regulate and give names to currencies like this, which is called International Standard Organization. They are the body that are responsible for giving such names and also pairing these currencies together for us to be able to trade them. So basically, Forex is the simultaneous buying and selling of currency. You buy one currency in exchange for another to get for profit um, purposes. So next thing I'll be talking about is how we tend to participate in this market. Let me give an instance. If you travel from one country to another, you are also participating in foreign exchange because if you are traveling from one country to another, you cannot use your um, own currency in that particular country. So you have to exchange your own currency to that of that country. By so doing, you are already um, doing what we call foreign exchange. And in forex, that is basically what we are doing on using our brokers. We are buying one currency and selling another. So forex will always involve two currency at a time. For instance, if a Nigerian is traveling to the United States, the person's currency is Nigerian naira, and the currency the person is exchanging to is United States dollar. So by so doing, that person is going to sell his own currency and take um, United States dollar. By so doing, there is an exchange. So basically, that's what Forex is all about. Are we together? That's what Forex is all about. And um, the thing is that determines the rate or the strength of a particular currency has to do with some microeconomic or macroeconomic activities that ranges from either the economic strength of a particular country or the interest rate of this particular country, the GDP, and several other factors determines the strength of a particular country against another. If the economy of Nigeria is bad, and if the economy in the United States tends to be stronger than that of Nigeria, definitely their own currency will be stronger than ours. And if you can see in recent times, dollar seems to be appreciating over Nigerian naira. Why? Because our economy is very, very bad, and United States economy is stable and okay. That's why their currency seems to be having and gaining value over naira. So in international trade now, if you want to exchange naira to dollar, you tend to be exchanging more naira to lesser dollar because dollar has more value than Nigerian naira. I don't know if you understand what I'm talking about. So the value of currencies is determined by the strength of the country's economy. If the economy is bad, it's going to have a direct impact on that country's currency. So the activities that play out in the country at that particular point in time, this also goes a long way indicating the strength of the currency under consideration. Okay, let me just briefly talk about the current war going on between Israel, Iran, and US also intervening now. The value of the currency of Iranians now have actually decreased to the least you can expect because of the war. That means their economy is bad, is not stable because of the things that are happening currently in that particular country now. And if you look at if you want to relate it to the strength of US economy in terms of world power, you know that US is by far greater than Iran in what they possess. So United States dollar is going to be much more value than Iran because um, the economy in the United States is still by far stronger than what is currently happening in Iran. So that's just basic. Basically, in a nutshell, what I'm just trying to explain to you is in foreign exchange, in Forex, what we do is we buy we buy the currencies of which countries have more value, then we sell the currencies of whose countries has lesser value. By so doing, we make profits of what we do. Going furthermore, um, there are people that participate in these markets. Yes, there are different players that are involved in these markets. We, on the other hand, we are just like 2% of these people. The whole, if you take statistics of all the forex traders, that's us now, the retail traders in the whole world, we are just like 2% in the global participation. We have the major players, which are the central banks, the commercial banks, the hedge fund managers, that's big companies, brokers, speculators, and we are just 2% out of these players. So you can see that we have um we are just small, we are just a small percentage out of the larger participants. The role of the central bank in foreign exchange is not to make profits, but to stabilize the country's economy. Like our central bank in Nigeria now, they participate in foreign exchange market. The reason is the um, to control the interest rates, to determine the interest rates. That's the interest rates, the exchange value of naira to other countries. It is the duty of the central bank to determine it. Then the commercial banks, the banks like GT, Zenith Bank, and all of that, they tend to go into the market to trade to make profits for themselves. The hedge funds, that's the big companies, the brokers, speculators, those are also large institutions that also participate in the foreign market. But we are just 2% out of these particular players. And um, the as I said, the goal of the central bank is of different nations is to stabilize their respective economies through the instrumentality of foreign exchange stability, which is easily achievable through determining appropriate rates. Yes, commercial bank and individuals, for instance, get involved for profit motive. For those of us that use commercial banks, let me tell you one thing that these banks also use our money to do. They use our money to trade forex and make profits them for themselves because they have a large pool of money to trade with. Yes, that's one thing they do with your money. Yes, they use your money to make more money in foreign exchange markets. So um, note this: individual participation in the forex market is only 2% to 3% of global participation. That means we have little impact in whatsoever is going on in the foreign markets, foreign exchange markets. So what we tend to do is we follow and trade together with these big players that tends to move the markets. We don't trade against them, we trade together with them. We follow them to trade to make profits from the markets. We don't trade against them because we are just a tiny piece out of the general participation. So we trade along with them. What is base and quote currency? You can recall in the definition of what forex is. We did actually say forex is the buying and selling of one currency against another. The buy and sell action taken affects the first currency in the pair and the second at the same time. Let me explain. For instance, now, if you are traveling, let me use the explanation I gave earlier. If you are traveling from Nigeria to the United States now, all right, you since you cannot make use of Nigerian naira in the United States, you tend to give out your naira so that they will give you United States dollar. In by so doing, you are buying United States dollar with the naira, and you are selling off the naira to gain the United States dollar. You are giving out your naira and taking USD. The same thing is happening. Two things are happening at the same time. It means you are selling your naira and you are taking United States dollar. That's an exchange, and that is basically what we do in the foreign exchange market. So, base and goods currency, the first currencies are always paired in twos. Yes, they are always paired in two. The first pair, which is by the left, is the base currency. Then the second one, which is by the right, is the quote currency. And there is one formula that International Standard Organization use in pairing currencies is that the currency the country whose economy seems to be much more stronger comes first. Then the economy with lesser strength follows. In essence, what I'm saying is the first currency pair you will see in the pair is the one whose economy tends to be stronger. Then the second one is of a lesser value. So in the case if the price of Euro USD is increases to 1,200. Okay, let me give you an instance. The value of the first currency is determined by that of the second. Okay, if you want to exchange naira for dollar now, the value of $1 is determined by naira. So in essence, if you are buying $1, you are paying a particular amount of dollar. So the value of the that's the first currency that appear in every pair is determined by the value of the second one. So if you are buying two, if you are buying USD now against naira, it means on our chart the price you'll be seeing is the price which $1 is being traded to naira, not the value of dollar now. The value of $1 to naira is what you will see. Are we together? So the first currency in the base, while the other currency that appears at the back is the code currency. The code currency serve as a reference point to determine the value of the base currency. Yes, that's what I'm saying. If the current price of a pair, in this case I use Euro USD, is 1.20,000, it means that for every €1 you need 120,000 to buy it. That's what I'm saying. Now for one euro, you can see two currency pairs are mentioned here, Euro USD. So if you are buying euro, it means you are going to €1 now, you are going to pay 1.20,000 USD, 1.2 USD. Let me round it up like that so that I won't get confused. If you are buying €2 now with USD, that means you are paying two of this amount. If the price of Euro USD increases to 1.21 now, therefore it means that more of dollar is needed to buy euro. So by implication, the euro now has strengthened. That means it has gained more value against the United States dollar. So let me explain otherwise. If the value, if the number here decreases to, let's just say 1.1 now, it means euro USD has appreciated a little to euro. That's when you see the decrease. But so long as there is an increase here, it means that euro is gaining strength in relation to United States dollar. This one, this is what I was explaining. In each currency pair, you will always see two currencies like this. The first currency that appears is the base currency. Then the second one is the quote currency. The value of this second one is what determines this one. If you want to purchase 20 of this, that means um the price of this one that you the price that you pay is determined by this one. This one is just 1 unit. Then the money required to purchase 1 unit of this is determined by the quote currency. You furthermore understand this as we go forward. So please, can you hear me? I want to be sure if you're hearing me. Can you hear me? Hello, can you hear me? So going further, we'll talk about brokers. Okay. For example now, if I want to let me use farming as an example. I'm somebody that I have money and I want to farm and I don't know how to farm. Then I contact somebody that is into farming that okay or that have access to farming, that's lands. And I contact him that okay, I have money and I want to farm stuff and I don't have land. The person will say, okay, we can do it this way. You can bring your money, then I I help you to do the farming. Then when the goods are ready for harvest, we harvest them, take a portion, then I also make my own commission out of it. So forex brokers, they are firms that provide traders access to the trading platform. It was never like this before. Forex has been in existence for a long time now, but the thing is, we didn't have access to this market because, as I said, it is a market where we buy and sell currencies. We didn't have access to this market not until when brokers started making us providing us platforms where we can buy and sell on. So brokers are simply people that give us access to be able to buy and sell currency pairs. So the success of a trader depends not only on the strategy, trade management, or the ability to detach emotion from trading, but also a large extent depends on the broker. Yes, there are brokers that will charge you more for them to be able to provide you access to the market, whereas there are brokers that will charge you a little. That's their own commission now for them to be able to provide you access to this market. And how they do this is by spread and commission. Spreads are different between the bid and ask price. That's the price at which you are buying and the price at which you are selling. Okay, let me give an instance. If you want to exchange Nigerian naira to United States dollar now, a broker can tell you, okay, currently the price of um, naira to dollar is around 1,399. So a broker can tell you, okay, bring 1,420, then I'll be able to help you to buy this. By so doing, they have added their own commission to it. So they charge you a little amount for you to be able to perform those transactions. So the type of there are different types of brokers that are available for us to use, and the ones that charge us less for us to be able to trade are the ones that we look out to. We also look out to their regulation, how regulated they are, and how safe they are. Because if you don't take into consideration the spread, that I mean the commission that the brokers do charge you and you work with them, it could be that you make some trade, you make profits, but the commission on your profit is too high. So you won't see much profit because of the spread that the broker is working with. So we tend to look for brokers that charge us less for us to be able to perform such transactions. Yes. So the success of a trader is not only depending on the strategy and other stuff, it also depends on the broker you are using. Yes, as you explore the world of forex, I therefore charge you to choose a broker that gives you minimal cost of on your transactions to guarantee quicker return on investment. Because if you are using a broker that charges you more, to be honest, you will make profits, but what you will be seeing is going to be small because the broker you are dealing with is charging you more. So I have um, three brokers I use, and I'll be dropping a link by the end of the class for the ones that I feel is very okay and safe for us to work with. So brokers are simply firms that just provide us access to the foreign exchange markets, and by so doing, they also make um, their own gains. So the foreign exchange markets It's open 24 hours from Sunday 22 GMT. That's from Sunday. That's around 9 GMT because we deal with GMT plus one. Around 9 and until till Friday 9 p.m. again. The reason is, um, you know, it's a foreign market and the world is involved in it. And due to time difference, because as we are speaking now, there are some countries that are experiencing daytime and there are countries that are experiencing night already. But by now, market is almost getting to close because markets close by 9 on every Friday and opens 9 on Sundays. So the reason why the market is 24 hours from Sunday till Friday, they look out to the time in which the central bank of every region that participate in the foreign markets opens, and these regions are um, London, New York, Asia, and Asian session. Yes, Asian session comprises of two major sessions that foreign exchange work with, which is Tokyo and New York. So in this um, in this in this during these hours, you can place any trade, you can execute trade, you can buy and sell within from Sunday 9 p.m. to Friday. You can open and close trades. It's open, then on Friday market closes. Then wait. You can still leave trades open, but it depends on the type of trader you have. So during these sessions, there are there are times when markets tends to be slow, that there are not much volume in the market. The market tends to be stagnant. It doesn't move like that. This is because um, let's just say okay during night, let's just say from 12 p.m. to 6 a.m. Market tends to be slow because the regions that are in daytime that particular time are not much. So there are not much people participating in the market, but still the market is still open. You can still trade. So we have London sessions, we have New York session, then we have Sydney session, and we have New York, Tokyo. The sessions that tends to be more active are London session and New York session because during these two sessions, more countries are active. Most countries' central banks are already participating in the market, and more people are there to participate as well. So we tend to deal with the sessions that have high volatility, that's high participation. London session opens 8 a.m. in the morning, and it overlaps with New York session for 4 hours. You can see that London session is open, then another countries, another regions, their market opens. So more people tends to be in the market, and it results into high volatility. Volatility comes when there are much players in the market. So markets tend to move very well at that particular time. But markets like Sydney and Tokyo tends to be slow because there are not much people that are participating in the market. But still, the market is still open. You can still take trades that particular time. So I was saying something earlier about spread when I was talking about brokers. So spread is difference between the bid and ask price of a given instrument. For example, now, if you want to buy euro and sell United States dollar, your broker has, if let's say the exchange rate at that particular time is um 1.14, your broker can add something at the end, like let's say a little amount to it, that okay, if you are buying euro this particular time, I'm going to charge you a little for you to be able to perform this transaction. If you are selling your USD, they also had a little fee on it. So the difference between when you are giving your United States dollar out and buying euro, or you are buying euro and giving out your USD, is the difference between the two is what is called spread. And spread is what your broker charges you for giving you access to that market. So spread is just like a commission that the broker charges you for performing a single transaction. And okay, one thing I will say is you can see that there is an explanation I give here. To minimize the spread incurred from brokers, you have to trade during the most favorable hour. That's the hours which market tends to move very well. When there are more market participants, that means competition for this business increases, and market makers often lower their spreads to capture it. The reason is there are much people that are coming, so the the price the spread tends to be small in this particular time. What I'm just trying to say is, if there are much people that are making transactions, these brokers, what they do now is they lower their spread. That's the commission they charge you, because a lot of people are making transactions. So they don't have to make much more commission from you, compared to when there are not much people in the market. If there are not much people, they can say, since people are not here, they can leverage and add extra commissions, because people are not. So they want to also get a substantial amount of gains by increasing their spread. So in I will always advise people to trade when the market is fully saturated, when there are players, a lot of people in market. That's London and New York sessions. That's mostly when people are actively trading. That's during the day. Yes. So spread is just the difference between the bid and ask price. What you are selling and what you are buying. The difference between them is what your brokers is charging you. So spread is not something that is really going to affect you if you are actually working with the right broker. It's not something that will affect you. So pips and points. Yes, pip stand for percentage in points. Yes, the way the prices of goods rises, yes, it can be determined by so many factors. So in forex, in forex, the prices move in points, in percentage. So a pip is what we consider as a point for calculating profit and loss. We are buying and selling. So the prices of currency fluctuates always. If you have seen a forex chart before, you know that you will see numbers that tends to be going up and down. Like you see red, you see green, and all of those things. A, a pip is the smallest amount by which a currency value can increase within a short period of time, and it is constantly changing. It is constantly changing. So for US related currency pairs, the one pip is equivalent to 0.001, and for pairs that has to do with Japanese yen, a pip movement is 0.01. So for example now, this green number you are seeing at the selling price, that's the bid price of euro, is what we call a pip. So if this value increases from 2 to 4, that's from this 2, the selling price now, and increases to 4. If you have bought euro USD and it increases to 4, that means it has increased by 2 points. And by so doing, you have made extra money depending on the lot size you are using. And the smaller the spread, the more liquid the currency pair is. The smaller the smaller this pip movement, the more liquid the currency you are dealing with is. Furthermore, subsequently, you will get to understand all these things when we are taking we are taking practical lessons. So, as I said, a lot size is the contract size of your transaction. Currencies are traded in specific amounts called lots. Lot size directly impacts the risk you are taking in a trade. We have standard size for a lot, which are 100,000 units, and there are also mini and micro lots. Mini lots are 10,000 units of the currency pair you are buying or selling, whereas micro lots are 1,000 units. Lot sizes and profits with losses go in end. By this means if you want to buy, if you want to participate in the market, you cannot buy, let's just say, you cannot just say you want to buy without determining the units of what you want to buy. So what lot sizing do is it helps the brokers to know the units of the currency you are buying. Micro standard lot size is 1.0, micro lot size is 0.01, then mini lot is 0.1. In units, micro lot is 1,000 units, mini lot is 10,000 units, standard lot is 100,000 units, 10,000 units. Yes. So this is an error here. Um, Movement value, that's the pips we talk about initially. If you are buying, if you are using micro lots, that means the pip value will be determined by this, and the unit will be multiplied by the lot size you are using. If you are buying euro USD with 0.01 lot size, it means you are multiplying this 0.001 with the unit. In essence, for each pip movement for using 0 points, that means if the number, the example I gave initially, where is it? If this number here, if it increases from 2 to 3 or to 4, that means 2 pip movement. Coming back, the value of each the value of each pip movement determines how much you are earning. If if you use this particular lot size and it increases from 1 to 2, from this 1 now to 2, that means you are earning 0.10 cents. If you use mini lots, that's 0.1, 10,000 units, For each pip movement, for each change from 2 to 3 or 2 to 4, you are going to gain $1. And for standard lots, for each pip movement, it means you are gaining $10 per movement. And the reverse is also the case. If the market tends to go against you, if it decreases from 2 to 1, if you use standard lots, you'll be losing $10. If you use mini lots, you'll be losing $1. If you use micro lots, you'll be losing 10 cents. Yes, that's how it works. So to take advantage of relatively small moves in the exchange rate of the currency, we need to trade large amounts in order to see significant profit. Yes, you don't want to be in the market and be making 10 cents, which is not even up to $1. So by so doing, 0.1, which is micro lots, mini lots, is referred, but it depends. It also depends on your capital. We'll talk more on this as we journey on. When you have no open position and so no floating profit or lend or loss, then your account equity balance are the same. Okay, let me explain this. If you have 10,000 naira and you put it into a business, and maybe what you what you are buying, the worth of that thing at that particular time is going to add up to your um, initial capital. What I'm just trying to say is, if you take out 1,000 naira, 10,000 naira and go into the business, and maybe out of that 10,000 naira, what you bought, you're already losing like 5,000 naira. It means your 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 equity now is going to be your loss plus your initial balance, or your profit plus your initial balance. If you are making 10,000 naira, on top of that 10,000 naira you initially deposited, it means your equity will increase from 10 to 20. Yes. So that's how I will explain further as we journey. But I just want to give you the background. I'm going to drop the slide and also the full lecture notes for us to gain more insight. So leverage is like the money your the broker you are dealing with now gives you to help you increase your purchasing power. Because to be honest with you, right, we don't have that much money to be able to participate in the market. But leverage helps you to have more chances, to have more buying capacity and selling capacity. As I said, we have big players that participate in this market, which are the central banks, the commercial banks, the hedge funds. That's these big companies you are seeing, like Amazon, like think of it, any big companies you are seeing, they are also participating in this market. So we cannot individually have money to trade with them. But what brokers help us to do is, since they are also big players in the market, they give us it is like a it's not it's really money, but they are not going to directly give the money to you. The money will be deposited into your account. And leverage is, let me let me just explain from what I wrote. Leverage is borrowed fund in order to scale up investment capital for potential returns. For instance, a leverage of 1:500 means that for every $1 you are bringing, that means you multiply that $1 by 500, which means you have the buying capacity of $500, bringing $1 into the market. That means, and it's kind of like risky, because if the market go against you, can your money can easily go, because you don't have up to that amount. They're just giving you 99% of what you're putting in. If you are putting in $1,000 multiplied by 500, you see it's $500,000, and you only brought 1,000 to the market. So it's just to increase your buying and selling capacity in the market. As good as leverage sound, it's also important to know that you can lose your invested capital easily when trade go against you. Let's say, okay, you came with 10,000 naira and the broker will help you to buy something of 50,000. Small loss will just take away that your 20,000 because they cannot lose their money. Their money is always fixed. Once the markets go against you a little, they withdraw their own money, then your own is gone. So this is where it's riskier. If you are using a higher leverage, it means you are risking your capital more. But if you are using leverages that are small, like 1:200, 1:100, it means you you are actually protecting yourself from exposing yourself to the market with higher leverage. But it is good to also have higher leverage for you to have a high buying and selling capacity. So in countries like USA, they regulate and protect their citizens cannot use higher leverage because they are trying to protect them from exposing themselves to higher risk. So there is a minimum amount of leverage a US citizen can use in the market. But for us that are in Nigeria and other parts of the countries, we can use any leverage so that we can make higher returns. And also, if that is the case, you can lose your money in as you trade with it. So equity, I was explaining equity the other time. Summation of your account balance with the floating profit or loss. Yeah, that was what I was saying. If if the equity changes based on price fluctuation from your current account, current open positions, that means the money you are taking to the business now, if you are making profits to it, your equity is your initial balance from plus the profit you are making. And if you are losing at that particular time, your equity is your balance plus your loss or minus your loss in this case. Do you understand? For instance, now you have $200 and you enter a trade, and on that trade you are making $50. Your equity is now $100 plus 50, which is equal to 150. And in the same way, if you use $100 and you enter a trade and maybe you are losing like $20, your equity will still be $100 minus $20, which is equals to 80. Yes, you have $80 because you are losing $20. So equity is basically your balance plus the floating profit or loss. Balance plus either you are losing or you are gaining money. When you have no open position, that means you are not taking any trade. Your equity and your balance is going to be the same. But immediately you open a position, if you are making profit, your your equity is going to be your account balance plus profit. Or if you are losing, your equity is going to be your balance minus your loss. Assuming you have open trades running a profit of $2,000, equity will be $2,000 plus your account balance. Current position is running a loss of $2,000. Your equity would be balance less $2,000. I hope you understand. So equity is basically the money you have in your balance plus the money you are making when you take a trade, or the money you are losing when you have a position open. But if there is no open position, that means your equity and your balance will be the same. Margin. Margin is calculated based on leverage. You know, I said leverage is the amount of money your broker borrows you so that you have um, high buying and selling capacity. Margin is the amount of money you put down as collateral for a wrong position or trade. If your broker is giving you 99% of the money you are using to trade, that means you have to drop a particular percentage as as you have to drop a particular percentage as collateral before you be able to take that particular trade. So let's say you have $10,000 account and you want to buy 1,000 euro against the USD. How much US dollar do you have to pay to buy 1,000 euros? Let's assume that at that particular time, euro USD rate is around 1,400 and four one point four hundred and 4,314. It means each euro equals one 1.4314 dollar. Therefore, to buy 1,000 euro, you have to pay $1,431.40. Understand this thing better. For 1,000 euros you are buying, it means you multiply that 1,000 euros with the value of the dollar. So the margin for you to be able to trade, for you to be able to buy 1,000 units of euro is 1,431.4 cents. Okay, let's say um your broker is helping you with 99%. Now if you add this 1,431.4 cents to 99% of what you your broker is giving you, is going to make 100%. So for every transaction you are making in the forex market, you drop a particular percentage as a margin, and it's calculated based on leverage. If you are using 1:500, 1:200, it will be your percentage minus. If for example now, 1:500 now, if you deposit $10, $10 multiplied by 500 is going to be your leverage. So for in the case of 1:500 now, for you to be able to perform a transaction, that means in this case you are dropping down 1% of that amount for you to be able to perform a single transaction with it. So the 99% your broker is giving you is on the other end. Then your collateral is this 1% for you to be able to. Because the reason is, since they are giving you 99%, you don't trade with their money. It's just to increase your buying capacity. If the trade is going in your favor, it's good, you make profit. But if it is going against you, this 1% you drop down now as collateral will go, because they will lock it in. So let's say um, you bought something and you are required to pay 10,000 naira to initiate a transaction, and your broker asks you to drop 1,000, they give you the 9,000. So the moment the moment the business is not going well and you started losing, immediately you lose that 1% that you have dropped. That's 1,000. The broker will take out their money, and you, your money is now on loss because they have already withdrawn theirs. I don't know if you understand what I'm trying to say. Yeah. It's just like a percentage required of you to drop down before you be able to trade. Yes. And it's 1% of your money for every transaction you are making. If you want to buy 10,000 units, you drop 1 unit, your broker give you 99 units, 99,000 units, 9,000 units, sorry. So We have others like take profits. Take profits is like an order you set to your broker to close you out of a trade when the trade is going in your favor. So now, let's say now you enter a trade and you predicted that the price of a particular currency will get to a certain point, and you took the trade, and the trade goes in your favor. Take profit is an order that you set that okay, at this point, please, I want to close my trade because I've made enough money. I don't want to continue again. You impute it manually or it can be electronically. Electronically in the sense that you just insert the particular price which you predicted that that particular currency will reach, then you put it. Then once price gets there, your broker will close you out of the trade. And you can also do it manually. Manually in the sense that you can do it when price gets there, you just close the trade and leave the market. We also have stop loss. Stop loss is also um, explain this. Stop loss is an order that you also set that when the market is not going in your favor, that means the market is going against you. The broker should close your trade and protect your capital from further losses. You can do it electronically and you can do it manually as well. You can set it, you can input the price and the level at which you want to leave the trade. How many dollar you are willing to lose, or how much you are willing to lose, and the broker will take you out of the trade when price gets there. So there's nothing much about that. So take profit and stop loss are orders you set when price is going against you or when price is going in your favor. So there are other market orders that I'll be talking about. We have other types. So now it's based on prediction, right? Market execution means when you are buying something instantly, you want to buy or sell a particular currency at that particular time. So instantly, when you buy, your broker option you in the trade. So this is called market execution because it is instant. It is instant in the sense that when you predict that okay, the dollar is going to gain value over euro, so you sell the United States at that particular point you are selling. Instantly, you are selling off the United States dollar because you feel it's going to gain value over the euro. So by so doing, your broker is optioning you into the trade immediately after executing. And we have pending orders. Pending orders are orders which are set that okay, forecasted prices that at this particular price, when price gets to this point, I want to sell my euro or I want to buy my USD. So we have others like buy limit, sell limit, buy stop, sell stop, and so forth. Buy stop is an order you set or you instruct your broker to activate a trade at a certain price level which is above the current market price. For example, now you perceive that the United States dollar is going to go up, but you are not going to be there to watch the market until the price gets there. You can just set an order to your broker that okay, when price gets to this particular level, just put me in the trade. And when the price gets there, the broker executes your trade and option you in the trade. If it goes in your favor, that means you are going to make profit. But if it go against you, maybe when price gets there, the price started coming down. That means you make loss. But if the price continues to go up, you will make profit. The same thing as sell stop. If you feel price is going to go down, there is an order you set which is sell stop at a particular price. If price go down to this level, put me on the trade. And when the price continues to go down, you make profit. But when price gets to that particular level and your broker have optioned you into the trade, and price now started going up, it means you are going to make loss because the price is going in the direction you have not predicted. So we have we have buy limit and sell limit as well. This buy limit is is an order, so it's a pending order because it is not instant as I said earlier. It is not instant execution. Buy limit is an order you set to and give to your broker that when price gets to a particular place, when price has reversed, that means in the opposite direction now. Price has reversed to a particular place. Please option me for a buy. That means you are predicting that the price of dollar will not fall below that. If you reach that place, it will start coming up again. So buy limit is an order you set and give to your broker. When price gets to that particular place, it's optioning you in for a buy trade and price will start going in your direction. But if the price continues to go down, that means you'll be making losses. It is just an order because sometimes you do your analysis and you will not be available at that moment to take the trade. So you can set this limit to also participate in the trade. So the same thing as sell limit. Sell limit is you perceive that the price will get to a particular peak and from that peak it will start falling. Okay, let me start more examples on this so that you understand better. Now, let's say the price of Nigerian petroleum now is high, right? So the price is rising, and you feel okay, there is a particular amount that the price cannot get past. So maybe when price gets there, definitely it will start dropping. So you set a sell limit there that no price cannot exceed this amount. So you set a sell limit there, and when price gets there, if it stops and starts coming down, that means you will make profit. But if price gets there and keeps on rising, that means you will be making losses. The same thing as buy limit. If there is a general decrease in the price of a particular economy and you feel that the price of one currency is depreciating and you feel that it cannot depreciate to a particular amount. If it gets to that particular place, it will reverse. Then you set a buy limit that when price gets to this level, it will surely come up again. So you set a limit, like it's like a prediction you you do before price gets there. So all these are market orders that you can set and give to your broker. And I recommend, but as a beginner, I recommend market execution because it requires you to make instant um, buying and selling. Then you watch the market. If the market is going in your favor or is going against you, you will know. So sell stock, buy limit, buy stock, all of these things are more of like experienced traders. They are the one that based on experience they know that okay, price of goods cannot go below this. Price dollar cannot fall below this level. Um, Euro cannot rise above dollar beyond this level. So all those things they have um, analysis they do to back up those things. So that's how we participate in the foreign market. So in a car, let me let me okay, this is an illustration of what I explained. Buy limits, order place below price when you begin market and go up. Now, market is still at this level and price is coming down. So you feel that when dollar decreases to this level, it cannot go below this level. So you set order here that if price reach this place, you want to buy. So if price reach here and it started going up, it means you make profit. But if the price reach here and you continue to go down, You have already entered the trade from there. That means you make losses. But if the price go up, you make profit. And we talked of stop loss. Assuming you said you tell your broker to option you in for the trade here, that means your stop loss will be below it. That means if the price go against you a little, they should close your trade that you are not longer interested. So you set your stop loss below your entry point so that the amount you are willing to risk per that trade, when once it reaches, your broker will option you out of the trade. So those are the orders we have in the market. Yes, I will explain this 7 minutes. I'll drop the slide on on the trailing stock. Okay, trailing stock it's more of like those that are using desktop systems to take trades. And trailing stock is like, okay, if I am in a trade and the trade is going in my favor, once the trade started pulling down, that's going against me by 15, 10 or 20 pips, the market should the broker to close you down. That means if you bought from here and it is going, maybe when it reaches here, it started coming down. You tell your broker that once it's coming down by 20 pip, that's 20 pip movement, they should close you. That means your profit from this particular point to this place is protected. Minus this now, you just be losing a small amount of profit you initially make. But if the market move from this place down to this place and started retracing again for 15 points, they will close you. If the market push up and retraces for 15 pips, they will close you. No matter the height it has gotten to, if it is just 15 points it retraces, they will close you out. That means your profits here will be protected. It is called trailing stop loss. Trailing stop loss. We will understand these things better when we are practicalizing everything about Forex. So that will be all for today. Let me do a quick recap on everything. So basically, I said Forex is the simultaneous buying and selling of currency pairs. Yes, you buy one currency in exchange for another. And the way we participate is through the access that is granted to us by our brokers. Our brokers are the ones that allow us to participate in this foreign exchange from our own end. And what it requires us to do is just to have these brokers with our phones and data connection. We can participate. One way to also participate is by traveling, exchanging one currency to another. Like as I such example earlier, if you are traveling from Nigeria to United States, you cannot use your currency in the United States, so you have to exchange it. So all these activities are what we call foreign exchange. So and it's a very large market. This is a market in which almost $7 trillion is being traded every single day. $7 trillion is traded in the forex market every single day. Imagine that kind of large market. If you can just participate and be getting, even if it is $20 every day, compounding it furthermore for like a month, you see what you have made. You understand? So foreign exchange market is the largest financial market in the world. It is larger than the stock market. It is larger than the crypto market. It is the largest financial market in the world, and we are just 2% out of the major participants of this foreign exchange market. So, congratulations. This is the foundation class. I believe for those of us that are new to Forex, we have um, we have questions that we ask, and I know this is a new thing that some of us um, have started to do, and I believe with time you get to have detailed knowledge about how Forex works. So I would expect to have questions. You can forward your questions to the discussion group, or you can send them directly to my DM so that I will attend to them. Michael, hello, can you hear me? So we have come to the end of the class today. I will be waiting to receive questions from you. Whatever you don't understand, you can drop questions in the comments in the discussion group, and I will attend to you. So we have come to the end of the class today. Tomorrow we continue and start with forex analysis, how we get to predict the movement of the foreign exchange market. So I'll be anticipating your questions. Congratulations once again. Michael, congratulations once again. So send your questions to the discussion group.